We're halfway through 2015, and although the broader markets haven't done much this year, some mutual funds, in fact, have been stellar performers in the past 6 months. The best performer is the SBI Pharma Fund, which has returned more than 20% during this time. I caught up with Navneet, Munot, Chief Investment Officer of SBI Mutual Fund, and began by asking him about the outperformance of this fund.
Year to date, the fund has delivered 17-18%, whatever you have seen, but even the last 3 years and 5 years, the fund has been one of the best performing fund across all mutual funds. If I remember correctly, I think last 5 years would have been 27-28% per annum. Last 3 years would be even higher, because the one that sector has done well, and within the sector, the stock picks that my fund manager has taken, I think they have done substantially better than even the index, both in the large cap and the mid cap space. I think he's been able to identify a couple of multi-baggers, I think stocks that have gone up 4 or 5 times after we bought, and that has helped the fund delivering the return that it has delivered.
Picking up on the pharma space itself, it's been one sector where valuations have been very high. That's been one of the biggest talking points for the sector. And even if you look at the last 6 months, the mid-cap, some of the mid-cap stocks have given 50% to 70% returns. So what are you making? Do you think the recent correction has sort of helped the sector become a little more reasonable?
I think there are always opportunities of identifying the right stocks. So as you talked about the mid-caps, so some of the mid-caps that we have picked up in last couple of years, they have gone up multiple times. But a lot of it is actually driven by the earnings growth or the promise of the earnings growth that they have. Because for a mid-cap company, I mean, 1 or 2 products, if they are successful in that, can make a very significant impact on that company. Some of the companies that have gone through certain restructuring, we were a little ahead in terms of identifying those opportunities and have done well. At any point in time, I think particularly in a sectoral fund, I think the stock picking is like quite important.
So would you be looking at a rejig or a change in strategy as far as the pharma fund is concerned, given the current environment that we are in right now?
Would be required, because in last couple of years, returns have come not only from, let's say, the re-rating of the sector, but also from high earnings growth. There has been a price inflation in US. Prices have gone up of the generics. That has benefited these companies in terms of margins. Indian companies have moved up the value chain from normal generics to more specialized generics. That has helped Indian companies. Some of the companies apart from US and India have moved to some of the other parts of the world, and there have been lots of things that have happened. So maybe there could be some impact on margins. Competition may intensify. One needs to keep in mind some of the regulatory risk as well, and that's why I think when you invest in pharma, a good portfolio is more important than investing in 1 or 2 companies. I'm talking from the investor's perspective, because you diversify that risk away.
What hasn't worked in the last 6 months are banking funds, led of course by how the PSU banks have performed. But do you think that could change in the coming 6 months?
So of course, even as a house, last couple of years, we have been overweight more on the private sector banks, some of the high quality NBFCs, and had less weight on PSU banks. And the issues with the capitalization, the issues with the NPAs, and some of those things are very well known. Maybe we are reaching a point, I'm not very sure whether today, but I think in next couple of months, if we get the kind of governance reforms that the government is talking about, if we do something more in terms of how do we restructure the existing NPAs which are there in the book, if ARC related, the asset reconstruction company related measures are taken, which can take away a good part of the NPAs, and they are managed in a different manner, I think there could be a case for re-rating of the PSU banks. But so far, maybe apart from 1 or 2 banks which we believe have invested in technology, have got a great franchise, and relatively they are better on the asset quality, we are playing that valuation game. But a broader call, moving a good part of money from private sector banks to PSU banks, I think we are still kind of in a consideration mode.
So which are the sectors that you think will lead this recovery going forward?
So obviously, if you are betting on a cyclical recovery, and that to our faith is that I think as the government spending picks up, we are already seeing that in roads, but I'm more hopeful on the, let's say, power T&D space within the power sector, as the mining sector gets revived after some of the measures that have been taken, some more spending on some of the other infrastructure sectors by the government and the state governments. I think the overall capital goods, engineering, construction, so overall industrials can do well, cement can do well, apart from the focus that the government has got on the housing for all for next couple of years. I think the sector in terms of the growth has been pretty poor, but going forward I think the growth may come back. We also believe, I think some of the quality financials can do well. Consumer discretionary is something, I think when you structurally, if the CPI is going down,
right,
and as the income levels go up, particularly in the urban India, urban consumption can see a revival. So overall discretionary space, but I would say a more stock specific rather than a top-down call in terms of sectors.
Going back to mutual funds, I want to ask you about diversification. How would you advise an investor to really diversify among mutual funds per se? Because the reason I'm asking is this entire focus on equities. Do you think there is an opportunity in debt, which has actually been giving double-digit returns for a while now, that investors are really overlooking?
So of course that will depend on each individual. They need
Yes.
to look at their return expectations, their time horizon of investment, their income needs, their risk appetite that they have, how much volatility they can handle, and then allocate money between equity and fixed income. Within equity, how much in large cap and mid cap, or let's say thematic fund. Within the fixed income, maybe a duration fund where you have a longer term money, for more than 3-5 years. I think on interest rates, our view is positive. We believe that interest rates are heading lower. There are opportunities in duration funds. There are opportunities in credit opportunities fund as more and more corporates access the bond market, and as the overall economy recovers, you have a credit cycle which can throw a lot of opportunities. So I think the fixed income market, apart from the equity where structurally next several years we are positive, even on the fixed income markets there are interesting opportunities emerging.
In the equity space, from a mutual fund perspective, would you have any recommendation on what kind of a sectoral allocation should one look at?
I think initially investors should start with allocation to a large cap fund,
Okay.
and then you go down the risk curve in terms of take higher risk, buy some more good diversified quality funds which are investing into mid caps, small caps, have more diversified funds. Those investors who are, I would say, savvy investors, more sophisticated investors who understand the risk of investing in thematic or sectoral funds, they should have a small allocation, but bulk of your equity portfolio should logically be in diversified equity funds which are multi-cap, large cap, or mid and small cap, depending on the risk appetite of each investor.
Right. And finally, how should an investor really approach their investment strategy over the next 1 year? Because you've got the Greece crisis which is rolling out, changing every day, as you said. We've got a possible Fed rate hike coming up probably in the next 6 months. And you have our own internal domestic factors as well that we need to consider, monsoon being another buzzword that's going right now. So how should we approach investments in the next 1 year?
So in the last 20 years, our funds have delivered 20%. Even if you look at the index, the kind of return that it has delivered over a period of time. I think India's economy is the cusp of probably a multi-year bull market in terms of the growth in the economy as well as the increase in the corporate profitability, which is at a bottom today. And I think investors are substantially underweight equities as an asset class. And I think the flow of money, the growth in the economy, the improvement in the corporate profitability put together will ensure that investors earn very decent returns from equity, beating inflation for a longer period of time. And my advice would be to keep that faith, have a long-term perspective, maintain the discipline of asset allocation. These events like Greece, and we have seen that in 2012, we have seen earlier also, I think these events provide a good entry opportunity. The recent 2013 episode of the whole taper tantrum, because of the talk about the QE unwinding in US, gave a great opportunity to investors both in the equity and fixed income market. So I think whenever you have these episodes, I think that gives you a good entry opportunity. So take advantage of the volatility rather than getting swayed by it.
Right. All right, Navneet. Thanks very much for
Pleasure.
joining us.
Time for a short break. We'll talk about portfolio management schemes on the other side. Stay tuned.